startups and sessions and specifically building it based on mobility for the country. And so without giving too much information of NSR Cell, because I'm sure that many of you know of NSR Cell, I would say follow us on all our social media channels, because we have a lot of new exciting things coming up. So I would further on introduce Krishnan to everyone here. So firstly, Krishnan, thank you for joining in here. And initially we were having a conversation saying that let's have it for a specific group of our startups. And then, knowing the time that Krishnan has, we thought that we'll open it up for anyone who can benefit from this session. And just to give a small brief of Krishnan is that, so Krishnan has been, I think, played literally every pivotal role that a finance person can play. And I would say that he comes with a wide range of experience from finance and the strategy side of things. He spent around 25 years in this space, from strategic planning to risk management to private equity to mergers and acquisition and also banking. So from early stage ventures to investing in early stage ventures to taking a company public, he's done it all. So I would say that, a little more about Krishnan is that he's also one of the key influencers and board members of a family office that manages literally around $1 billion worth of logistic in the logistics sector. And he is also a board member in a listed company that is in the NSE and BSE. He's also a person that invests in early stage companies. So from the valuation to hand-holding them to even advising them and being on their board in the early stage venture creation part of it, he's spent a lot of time there. And over the past 10 years, he's also spent time in mergers and acquisition and also buyout transactions with over about five. So he's also raised money for about $600 million worth of multiple rounds of funding. So he comes in with a wide range of experience. So what we're going to spend time on here is, for all you early stage ventures or people looking to raise money, I think there's no other better person than Krishnan to have on board. So he's also a BITS alum and also a MIT Sloan alum. So I think Krishnan is also advising the government and banks, and he's also advising private sector banks on how they should be going about their business. So over to you, Krishnan. A very small introduction to what experience that you have. So I will hand it over to you, and my colleagues also, Shraddha and Shloka, were on call. There might be some questions on the chat window. So in case you have in case you have any questions, please post it there, and my colleagues can also ask. Will ask you, Krishnan. Yeah.
Thanks, Vikyat. Vikyat, am I audible?
Yes, you are.
Right. So thanks, Vikyat. That was a very kind introduction. I guess I'll just do the disclaimer. Again, the views are my own. They're not representative of any of my investee companies or the companies where I sit and do some work with. And, this is, I'll take about 45 minutes to go through the whole thing, post which we'll have a Q&A. I'll attempt to answer as many questions as possible. I would ask you to, I request you kindly to soft mute yourself and, forward the questions across to Shloka or Shraddha, along with where you come from, what background you come from, so I can try my best to customize my reply to the domain you belong to, or you could be an investor, you could be an early stage startup or a mid-stage startup, or you could just be a bystander interested in this entire thing, right? So let's just move. Now the flow is going to be this way. Let me just time myself so that I don't get carried away. Hang on, just a minute. I kind of, hold on. All right. So what we're going to do is, how we're going to go about it is, hang on, why am I not moving? Okay. So a little bit of, before I get into the actual startup mode, a few pointers, a few things I'm going to be using, interchangeably terms is, one is entrepreneurs, founders, promoters. To me, they're more or less the same because they all have skin in the game in one way or the other, because they all are committed to what they have started. And the other side are investors, backers, or angels, VCs, PEs. So I'll use these terms interchangeably. The other thing is goals. Your goals can be manifold, right? I mean, I've discussed about 5 items over here. The first goal, of course, for anybody and everybody, especially for a for-profit, is growth in revenues. Because if you pick up an annual report, if you look at an income statement, the first line item is revenues, or gross income, or sales, whatever you call it, right? Then comes profitability, because profitability is something, irrespective of what you do, you have to keep an eye on profitability. Let's take an example. Now, if you look at last year, the past 2 years, if you take Zomato, for instance, their focus was on revenues. They wanted to grow, and they ended up acquiring Uber Eats. And now Deepinder Goyal's last statement was, I'm going to be turning profitable in about 12 months. This is about a few months back. So profitability could be another goal. I mean, I'm not saying these goals are individual. You can have 1 or 2 goals, but I'm just putting it across to you a set of goals that you need to have. Third could be market leadership. I don't know if you've been following this firm, Dunzo. I haven't used them as yet, but I've been a recipient of things from Dunzo. People have, I think it's become a generic term now. You know, in America, they say FedEx it. Here they say, let's Dunzo it. So the other day, it so happened that I got into a conversation with someone, and so he said, I think you should talk to Biswas. I said, all right. I said, let me talk to him. And so we spoke, we exchanged some thoughts. So he was talking about market leadership. He says, I want to be the leader in the hyper-local market. I mean, that's what he wants to do. So be it. So it is not profitability at this stage, but at some stage, it will be profitability. Then the other goal could be building a superior product, right? I mean, you want to kind of, especially if tech is the product and tech is not the enabler, tech is the product itself, or if it's an IP that you have, that could be a goal. And the final thing, which is, we all need to keep this in mind, is it could be exit at an X multiple, right? I mean, you may not want to exit, but the moment you get one of these backers, be it a family office, or be it an angel, or be it even a friend or a family, they would want an exit. And as we go through these slides, you would know that investors, they prefer if you have a clear-cut pattern, or if you have a clear-cut story where you think you can give them some way of an exit, right? Now, having said that, I firmly believe whatever you do, I mean, you be it in the brick and mortar space, you be it in a, how do I put it, a tech space, or you be it in a non-profit space, it doesn't matter. The focus is remain on value creation. You're here to create value. It should be on sustainable growth, right? It's good to grow at, 30% month over month. It's great to grow at 30% month over month. It's not just good to grow, but I mean, is it sustainable? Because at some point in time, you'll hit a plateau. So what do you do then? Next is cash flow management. Now, I come from the old school of thinking, and for me, cash flow is key, and this is something we'll talk about. We'll revisit this point in a bit. Next is earnings growth. Earnings growth is extremely important. Again, we're talking about profitability. And the last is, I want you to all, I see a lot of young heads over here. I want you to keep one thing in mind is that responsibility towards stakeholders. When I talk about stakeholders, I'm talking about just not shareholders or your investors. I'm talking about your vendors, the ecosystem you're operating in. It could be the government, it could be your employees. So that's what it is, right? So this is something I want you to keep in mind before we move into the next slide, right? Now, what are we going to be talking about? So this is what, hang on, let me just, I'm not familiar with, okay, right. So this is how the session is going to flow. First is we're going to give you a landscape, an overview of the startup ecosystem. It's important that you know about it. I'm sure a lot of you would know about it, but let's revisit it. We'll take about 5 to 7 minutes before we get into valuation. We'll talk about valuation. We're talking about creating value, linking that value to a valuation, or let's say a number, and what are the methods that we follow. Then we visit investor expectations. What is it that the investor wants? I've done some investments. I've been investing ever since, I think when I was in college, I started investing. That was way back. When I was about to graduate, I started investing. That was way back in 1990, 91, I started investing. And, I've been investing. I think not a year goes, which is not a good thing, in fact, without buying something new or exiting something. It could be a listed entity, or it could be not a listed entity, stocks in a listed company, or it could be a startup, or it could be a social enterprise. So what is it the investor is looking for? Because I've run a PE, I've run a balance sheet of about $1 billion in between 2003 and 2009. So I've done some great investments. I've done some horrible investments. So we'll talk about it. Then the key thing, valuation conundrum, which is what is it? How much to raise? How much to seed? How do you go about seeding your equity? And then we'll conclude it by, we'll do some cases. These cases are not what you lift from a textbook or something. Here we're talking about, these are stories where I've been involved in. I won't elaborate too much. I'll talk about each of these instances, what made me invest into these companies, and where I am at this stage, right? So let's look at the landscape. Just hang on. Shraddha, am I audible? Are we good so far?
Yes, Krishnan, you are audible. Yeah.
Great. Okay, good. Now, okay, let's look at the landscape. If I look at the landscape, let's go back to conventional investing or conventional companies. Now, what is it? How different are they from a startup? So the main thing is, an established entity have run the course through various business cycles. I mean, you take Microsoft, for instance. You take a Unilever, for instance. It's been there for years. Now, I advise a private sector bank. I mean, that's been there for 108 years. And they have never skipped dividend in those 108 years. They've seen business cycles, right? So there is something, they have set a precedent. Now, investors want a track record. They prefer a track record. I'm not saying that they want a track record. I say they prefer a track record. Time-tested model. The important thing is they go with the flow. Since a large part of these companies are listed, there's no fear of missing out. I can always go, claw back, I can pick it up, I can buy in the market. And they don't jump up by 30%, 30% day over day. We're not talking about Tesla here, we're talking about companies which are predictable, right? Now, who are the investors? The investors are seasoned investor. Well, I am a seasoned investor. I may not be a good investor. I may not be a bright investor. I may not be a smart investor. But the fact is, I've been investing since 1990s. I'm a seasoned investor. Or it could be a strategic investor. I mean, Take, for instance, Reliance Industries, Reliance Jio. What has happened? You had Facebook and you had Google investing. Were they investing for the sake of a return? Yes, maybe. But was that the main criteria? No, obviously not. Because Facebook owns WhatsApp, and WhatsApp is probably JioMart or Reliance Retail wishes to tie up with WhatsApp, do deliveries perhaps once the payment system is in it, or kind of bundle it with Jio, whatever it is. And, second is Google. Maybe Google wants a peek into what Jio is doing. And what is it? How much did they invest? 5 billion, 7 billion? What is that for Google? Nothing. Then you had two more investors coming in, smaller amounts. You had Intel and you had Qualcomm. Now, why are they interested? Very simple. Because Jio is going to roll out the 5G system. So you have Intel and Qualcomm, both heavily interested in the 5G scenario. So they want to see where this is going. So these are your strategic investors. Now, can startups have strategic investors? Of course, we'll talk about. Then you have the institutional investors. I mean, these are your FIIs, domestic institutional investors. You have the private equity firms. You have the retail investors who are people like you and I. The newbies, you have people who are new into investments, who haven't tried a hand on investments. You have them, and you have traders. The latest craze is Robinhood. I heard about it from a friend of mine. I mean, I had no clue what it was. I thought it was just a trading app, and he was kind enough to explain to me what it does. So you have the traders, right? Now, the next thing is very, very key for you. The predictables are liquidity. Because I, as an individual, put a lot of premium to liquidity. If there is something that is liquid, there is something that is illiquid, I shall choose the liquid unless the returns are justifiable. That comes to my next one, the returns. Returns are, yes, the returns are predictable over here as well, because again, the fact that they've been in the business for many years, it makes sense. There are safeguards because, you're listed in the market, you're regulated, so it is an investment risk you're taking more than any other risk. So this is to give you about the brick and mortar companies. Now let's get into startups. Now, before I get into startups, I'll talk about something else. What led to startup investments in India? So startups are nothing but alternate investments. Now, prior to the 90s in India, majority of alternate investments were in real estate or commodities. Now, private equity, which is the precursor for all these venture capital and angel investing and all that, it was in vogue throughout the 80s, and they were called the leverage buyout companies. You have KKR, you heard about KKR. Now, KKR was more of an LBO firm. And, in India, you had them selectively from the late 90s. The first set of PE firms were Bearings, became subsequently ING Bearings. ING Bearings ran one of India's very first private equity fund. They did some great investments. The Emphasis Software was one of their investments. And, one of the doyen of private equity investments, investing in India is Subbu, who was the managing partner of ING Bearings. I'm privileged, I'm honored to sit on one of his investee company boards even today. I keep referring to him on anything on private equity, and I've told him I keep pushing him to write a book. And Rabobank, again, just this morning, Rajesh Srivastava called me and he says he's speaking at a seminar. I said, sorry, I think we're clashing. Unfortunately, I said, if I would drop myself and listen to you than listen to me, but I'm tied up to this. So Rajesh set up Rabobank over here, and they were the first to start investing in the agri and the food sector. So these were large ticket deals. They were large players. They were betting on growth. Now, private equities, unlike VCs, they come at the growth stage. I want you to keep this in mind, because you shouldn't get disillusioned saying that if somebody says, hey, let's go and meet this PE firm, this firm is interested, maybe interested in your startup. Yeah, maybe they could be, but don't pin your hopes on them. They're more into growth capital. Now, the VCs and the angels were offshoots, right? A lot of these guys who were private equity players went and joined venture capital firms, or they set up their own venture capital outfit, or they became angels. Now, let's look at startups. Let me just move this a bit here. All right. Now, let's go back. Now, I've divided this into three parts. Shraddha, again, this is visible, right?
It is visible, yes.
All right. So the first part is all about to give you a background about startup investing into India. Second part is all about how does a startup look to an outsider? It could be to a layperson, or it could be to anyone. What do they see in a startup? The last part is all about, I'm going to throw a few bits. We're going to revisit these pointers time and again. Well, let's look at Amazon. It was set up in '94, along with, I think, eBay followed Amazon, and then you had, I mean, it was more a bookstore. I mean, then before they started branching off into all these things. And then you have the Japanese company, Rakuten, set up sometime in '96 or '97, not too sure. And of course, Alibaba launched itself in 1990 in China. And then you have the '98, '99, the dot-com bust that happened. A few companies survived, a few companies did not. We'll talk about why they couldn't survive. We'll talk about it as we go further. Now, where was India then? I mean, like, India was nowhere in the startup scene, but things started changing from the millennium. We had the IT companies, you had the staffing boom which is happening, right? As much as people, don't like me mentioning this, stating this, I refer to the likes of Infi, TCS, Wipro, not as tech companies. I refer to them as staffing companies, because that is what they are. I mean, they're not tech companies, they're staffing companies, right? And now they're trying to acquire some real technology companies and morph themselves into tech companies, right? So this is where India was. Then, sometime around the mid 2005, 2006, 2007, you had a few people knocking on India's doors. You had NEA Ventures coming in, which is now Vani's company. What's it, Kalari Capital? Yes. So Vani used to be with NEA Ventures. She moved to India. She started NEA Ventures in India. It became Kalari Capital. Then you had SoftBank, Sequoia, Tiger Global, and Axel. These were one of the first few VCs which, I won't say set foot in India. They were using the Singapore offices. They were using, they were flying in, doing some select investments. One of the very first investments where Just Dial was one of them, I'm talking about startups, the few startups. Some of them didn't take money from VCs. You had Freshdesk, InMobi, Flipkart, much later, Snapdeal. Raghu started Taxi for sure. He subsequently sold it to Ola. You had Zivame. Richard started Zivame, which is much, much later. Now, who were the promoters and what were the promoters' personnel? Whether you like it or not, they were from premium schools. They had spent some time in the Bay Area, and they were in big cities. They were in Bangalore, or they were in Delhi, or they were in Mumbai, or Hyderabad, not so much in the initial years. And the investor psyche, unfortunately, and it plays, I won't say it's the primary thing today, but it plays a role today, is the premium schools. What school did you go to? And the Bay Area trap. Okay, I mean, like, are you from there? Did you do a stint over there, or were you working with some firm over there? Well, I think it's rubbish. I'll tell you why it's rubbish, and while happy to take questions from you later. Now, there's one thing I want you to keep in mind is, I think it wasn't 2015, I think it was 2016, 17 onwards, data became cheaper and the smartphones usage went up. Okay. So these things, this is to give you an idea about the startup system, what it looked like. Okay, now let's look at now what a startup looks like to an outside investor or to an outsider. Ideas of the POC stage. Over here, it's primarily bootstrapped. You have angels coming in, select smaller or niche VCs who come in, lend some money or invest some monies into the startup. And next you have the client acquisition stage, and then you have the major client. You acquire a large client, or you go into a strategic collaboration with somebody. Well, you think it's an initial payoff. It's a chimera, if you ask me. I'll tell you why it's a chimera later when we talk about the dilution. We talk about what should a startup aspire to do. Then you have the growth. Growth kicks in slowly. The moment you start burning cash, naturally growth will come. And it's a feedback effect, right? Because you grow, you burn cash. You burn more cash, you grow. Now, cash burn is a term I want you to understand. Cash burn is primarily the difference between your inflows and the outflows, or the funding that's required. You know how much you're burning. Ideally, you need to have 9 to 12 months of cash flow. I'll tell you why again, 9 to 12 months. And the scenarios are, everything is scenario based, as a founder, as an entrepreneur, you try to build something on a base case. You try to also look at it from a worst scenario, or you look at it from an event driven. When I mean event driven, I'm not talking about a pandemic event, or I'm not talking about a catastrophe, or I'm talking about it could be a client coming in, or it could be a macro event, a government changing a regulation. So event driven, what happens? So you do some scenarios, right? The next thing, in the short run, I want you to keep this in mind. Cash flow is key. Cash flow is extremely important in the short run. In the long run, all that matters is profitability. Okay, but in the short run, I want you to keep in mind cash flow is key. Now, unfortunately, majority of founders almost always fall into the trap. Now, I don't have that much data on India because I have some data, but majority of startups, they wind up or wind down, whichever part of the world you are in, you usually either wind up or wind down. On account of the second most reason is shortage of cash. We'll talk about the first reason why startups close in a while. On slide 6 or 7, we'll talk about it, right? Next, I'm going to talk about, what are we talking about? I'm going to talk about here the beta effect. Now, what is beta? You have beta, you have sigma, right? Both are risk. Sigma is standalone risk, standard deviation sigma. Beta is correlated risk, right? Correlated volatility. Now, beta can also be good because, beta, if you benchmark beta to an index, to a market, to a GDP, when a particular sector grows, that stock grows, or the company does well. So likewise, does it work for startups? Yes, it does. We'll revisit this. Next point, flavor of the year, flavor of the quarter. God. Now, everybody is talking about logistics. Everybody is talking about warehousing. Now, I've been running a logistics / warehousing entity, rather like I had strategy for them for the past 6 years. I was involved, we were invested. Warburg Pincus was an investor. When I got in over there, we were able to bring in IFC Washington. Then we did an exit to DP World. This is about 2 years ago. And, and I know for a fact, I understand logistics probably better than any of the other things I understand. I'm not sounding presumptuous by saying that. There are others, I understand it better than others. No. So today, everybody is talking about logistics, and everybody is talking about 14%, 15%, 17% return. No, it's not possible. I'm telling you it's not possible. However, that is the flavor of the year. That is the flavor of the quarter. money is chasing logistics. So I want you to keep that in mind, right? Next is founder skin in the game. This is something I ask startup founders. What is it you have put? How much of money have you put? Or why are you so committed? Why should I invest in you? Next is macro trends. What are the macro trends? So today, everybody is gyrating towards cloud. Everybody is gyrating towards work from home. So what kind of a sector are you on? I mean, are you on, if I have to mirror you with the macro, the economy, are you going together? Are you going the other way? So that's important for me. The last thing is, as a founder, how do you portray the story and yourself? Hopefully, at the end of the next 40 minutes, I hope that you'll be able to take some inputs from here and pitch better, right? So let's just move now. All right. It's just, okay. Let's look at valuation now. Right. Now, let's look at valuation. Now, first thing is, why are you doing what you're doing? You know, if you are a startup founder, I mean, you have a trade-off. I mean, you think you want to do something, you want to change the world, or you want to make some money. You may have a host of reasons. One is, why are you doing this? You know? So let's arrive at something called the value hypothesis. This is extremely important before we migrate to the growth hypothesis. Okay. Now, value hypothesis is all about what is it you're building? What is the service you're offering? Right? Second is who? Who's going to buy it? Or who's going to use it? Third is how. How are you doing it? First one talks about you. Second one talks about your client. Third one talks about your business model. What is you? Your product? Who's your client team? Or who's your target audience? Who's your total addressable market? TAM, SHAM, whatever you call it. And how are you going to go about it? That's your business model. Very simple, right? So that's extremely important because you have to have what is it you're building? I mean, whatever you do, is this going to make a difference in what way? Are we going to talk about a cost saving? Are we talking about a time saving? Are we talking about a convenience? Or are we talking about an experience? Or are we talking about feel better? Or are we talking about, I'm just asking, you need to ask this for yourself, right? So, I asked Richa this. I said, you're in the lingerie business. She said, no, I'm not in the lingerie business, Krishnan. She said, I'm the intimate wear business. I said, what's the difference? She said, there is a difference. So you ask yourself, what is it you're doing? What does your product do? Okay. So that is something you can answer better, but I'll come to that. Where do I operate? I've just bracketed this into 3 segments, right? I bracketed this into a B2B, a B2C/retail, and I've bracketed this into B2C, which is, let's say, it's a consumer who's going to use your product. However, at this stage, you're reaching the consumer through a business entity, a channel partner, let's call it, right? Okay. So you have to ask yourself, where do I operate? Now, there are certain things which have more weight in some segments compared to the other segments. So I've attempted to list them down. In the B2B, you need to understand which industry are you in? What are you catering to? Are you catering to the tech field? Are you catering to the logistics field? Are you talking to the retail field? Who's going to be your client? Is it going to be accountants? Is it going to be, drivers? Is it going to be managers? Whoever it is, right? Next is, I just love this, product market fit. Now, what is product market fit? Very simple. You need to have user acceptance. You have a lousy team, and which results in building a not a so good product. You go and hit a great market. Let's say a lousy team, great market. Market wins. Let's do it the other way. You have a great team. You build a great product. You hit the market, but it's the wrong market. It's a lousy market. The market wins again. So you need to find a balance. So as I mentioned, as a cash is the second reason why startups wind up. The first reason is product market fit. You haven't addressed the market correctly, or you're too early for the market, or you have a product which is not what the market wants, or the market likes it, but they want something more, like Orkut. Orkut was way ahead of Facebook. Or the other company is Vidi. Have you heard of Vidi? Vidi is what Instagram is trying to do today, videos. Instagram got into videos because TikTok, thanks. I mean, this is what I talk about, regulations, macro trends, right? And event-driven. The government banned Chinese apps. You have people launching in India, it's event-driven. So Vidi was primarily a video thing, which Facebook acquired, I think, or I'm not too sure, or they had a strategic collaboration, and I don't want to badmouth Facebook or anything, but it just didn't work out. So product market fit is extremely important. You need to have a good product. Next is domain expertise. If you wish to build a product catering to the logistics sector, you need to understand that sector, extremely important. Next is your business model, because when you sell to a B2B, the B2B client is very, very finicky, unlike a B2C client. A B2C client will just stop subscription. A B2B client would want to know what's your business model. Will you survive for the next 3 years? Because they're betting on you for some division of theirs, or some process of theirs, or for some function of theirs. Adaptability, how adaptable is your product or your service or your platform, right? Product robustness, how robust is it? Because you would have to kind of mirror their system. You may have to go and sit on their systems, right? Pricing is the key over here. Pricing, in fact, pricing is key in B2C, but B2C pricing is known, but B2B pricing is not known. So you got to strike the right pricing. Then you have the B2C market. Again, I'm talking about product market fit. Consumer preferences. What is it the consumer want? What are they looking for? Third is market clearing price. Market clearing price is nothing but at what price will they take it? You know, Spotify is a great example. It's a different price for different markets. I mean, I had a Spotify US account. I changed the Spotify India account, and I'm saving a lot of money because this is the price at which consumers will take it in this country. Same thing goes for Amazon Prime. So what is the market clearing price? Acceptance rate. Now, acceptance rate is key because here is, the key thing is, we'll come to the numbers in a bit, in the next slide perhaps. One of the key things I look at is, what is your rate? I'm adding on so many people. Or before we get into attrition rate, let's look at people who have downloaded my app, people who are paying for my app, and how many people are losing out. So that gives you an idea about acceptance rate, right? Then your scale and growth, at what rate are you growing? I mean, if you're growing at about 10, 15% month over month, it's fantastic. It's very good, because in which case, I mean, you're growing on a compounded basis, you're growing at about 175% year over year, Then you have the B2B2C. Let me just sip some water. You have your B2B2C, which is like, again, industry matters, product flexibility, product market fit, business model adaptability, business pricing. This is similar to your B2B and B2C because you're just using a channel partner, right? Next what? So you have done this, you figured out your value hypothesis, you figured out your product market fit. Then you ask first, is tech the product or is tech the enabler? Now, this is the problem with WeWork because tech was not the product. They tried to package tech as the product. No, tech was just the enabler. You know, it is a great product in terms of co-living, sorry, not co-living, co-working space, right? User persona, to a user persona, who's going to be using it? And what is he, she, or what is the company going to pay for it? What's the ecosystem? Build an ecosystem around a user persona, you know? Who are your peers, complementers, who can you work with? There could be another startup in this space, you could collaborate, or you could, it may not be a startup, it could be a company which is, you know, trying to get an entry into the space and it's an IP that you have without giving your IP away. Could they white label and sell your product, you know? So look at it that way, ask first, ask next. What is the differentiation? Now, this is where your product market fit comes in beautifully. Okay, what is the differentiation? Okay, how are you different from the others? And what is the near true addressable market? Let's not carried away by the silly things that India is a 1.2 billion population. You know, there are about, 500 million smartphone users and, you know, let's not, when somebody gives me those numbers, it scares me away because I said, no, you come back, cut the chase. What is your market? Whom are you selling it to? And what is the price? Well, people buy at this price. Okay, so get that straight. Get that what is near true addressable market. Now, all this will just, we're talking about here the building blocks. I mean, I know a lot of you, almost all of us are confined to our home, so you must be exercising indoors at home. The first thing you do is you do some stretches. You do some light exercises to connect the tissues. This is what we're doing right now. And this is important before you start lifting heavy weights, right? So this will move you to the growth hypothesis, okay? So you have the value hypothesis and you have the great growth hypothesis. I mean, these are not my terms. The value hypothesis was coined by, what's his name? He was a chap who used to work with Don Valentine in Sequoia Capital. So he coined the term value hypothesis. He said, before you talk about growth hypothesis, let's go back to value hypothesis. So they coined these terms, and product fit is something I spoke to you about that is extremely critical. Because the first reason why a lot of startups do not take off or fail is no product market fit. Then comes cash. Okay, let's move now. We're still in valuation. Now we are on methodologies. Okay. So what are the methodologies? There are 4 that are used. One is the EBITDA DCF multiple. I'm a big fan of that. I'll tell you why I'm a big fan of that. The next is replication cost. That's simple, but you can't use it all the time. And then you have a revenue multiple, which is extremely popular with SaaS startups, PaaS, any of these startups which are growing at a good pace. And then you have the back of the envelope calculations. I'm not saying ignore it. I think a lot of investments happen that way. I've done a few investments that way. Now, what are the challenges? It's like, 3 days ago, on Monday, when Shraddha made this public, she got a mail from a gentleman saying that, I'm a zero revenue. I don't have any revenue. How can I value myself? Yeah, hopefully I should answer this question. Or this slide should answer the question. If it doesn't, the last slide should. Even if it doesn't, you call me up. When you do the Q&A answer, you could ask me the question. I should be able to address that. Okay. So that's a challenge, because startups, especially early stage startup, you're on the idea POC stage, or even if you have a client or clients, the users rather, they're not paying at this stage, or they're not paying enough for you to justify some kind of a valuation. The product is evolving. because the product always evolves. It keeps evolving. It takes about 1,050 days. I'm talking about 3 years for it to, make a proper bet and see where it's going. The IP, you have the IP. Can that be valued? Do we have a valuation? Can we, attribute some kind of a valuation to an IP? And then you have opaqueness in market information, right? Because whatever information, I mean, you hear about report, oh, this startup raised $1 million or $2 million. You don't know how much they seeded. If I was a founder, I wouldn't want that information going public, and you shouldn't either. Why should you just give away information to the market you don't want others to have, right? So where are we now? Okay, let's look at the methodology. First is your EBITDA multiple DCF, not so much for early stage startups. It's a great metric because ultimately every startup would morph into one. So when you morph in, start growing, I mean, when I talk about cases, this initial startup investment I did, this is way back in 2016. We turned profitable last year. We are in the final stage of raising pre-Series A second two. We haven't done a Series A, and again, what is it we've used? We've used the EBITDA because it has turned profitable. We've done projections for the next 3 years. So this is something where you think cash flows are predictable, or you think you can make a bet. Now, why I'm saying this is investors prefer this, right? Because it's a near true picture. It mirrors valuing established entities. The problem with them is the assumptions fallacy. Your assumptions need to be spot on. You need to kind of make sure that, again, yes, you can run a base case scenario. You can run a worst case scenario. Again, the assumption is the mother of all, what it is, right? So, right. Next is your replication cost. Very simple. If technology is not the product, it's not a bad methodology. It's easier to write, right? I'll give you an example. In 2007, I'm just trying to get I should have done my homework. MTR, we're all aware of MTR. So when MTR decided to hive off their packaged food division, you had Aquarius Investments from Singapore, and you had JP Morgan private equity investing into them. I think it was in 2002 or 2004. Yeah. So that was done more or less on, okay, for me to set up, for me to invest into a company, for me to build a brand, how much is it going to cost me? So why don't I just buy it, right? And they use a multiple. They use a revenue multiple. I think, I know for a fact that Aquarius paid 3x of revenues to MTR at that time. It was valued at 3x of revenues, and subsequently it was sold to the Norwegian food company, Orca, I think, they made a sweet deal on that exit, both JP Morgan and Aquarius, right? A2B, Adayar Anandabhavan, A2B, again, great company, great sweets. But again, Srinivas and Venkatesh, the owners don't want to seed equity cheaply. And okay, I give it to them because, they were trying to raise money. Carlyle was interested. TPG was interested. And I don't think they have raised money because what they were asking for was a bit too high for the likes of these guys. This was way back 2 years ago. Now, what is the methodology you use? You just use a replication. You could use an EBITDA, but do you want to, let me not be unkind by saying that, can you rely on that EBITDA? I don't know. These are proprietorship firms, so, past financials. So I just look at the replication cost. You could use both. You could use DCF. You could also use replication costs, right? Now, what is the problem with this methodology is it misses out on key things. It misses out on IP. If tech is the product, this is not a good methodology. It also misses out on key things like intangible. You could have a great name. You could have a great set of people working in your company. It misses out on that, right? Next, you have the revenue multiple or the SaaS. Shraddha,
Yes, yes, Krishnan. Tell me.
it's 45 minutes. Shall I use the same floor or do you want me to hurry up?
I think it's fine, Krishnan. As
It's
far
fine,
as,
right?
Participants are there. Yeah, yeah, they should be.
All
fine.
right, great, okay. Right, so revenue multiple is extremely popular. Provider clear-cut forecasting of sales can be done. Very simple, just take a piece of paper, revenue per user, number of users, net number of users, less attrition rate, times lifetime value of a user, how long he or she is going to be using your product. If it's an enterprise, they'll use for at least 5-6 years. Even if they're unhappy with your product, the fact that they've gone through your product, it has taken them time. It has taken them time to implement it, to get familiarized. They won't just change it overnight. So lifetime value. So it's very simple. Revenue per user, let's say revenue per user is $100 per annum. Number of users, you have 10,000 users. 100 into 10,000, you get 1 million. Times lifetime value. Right, each user is there for 2 years at least, minimum 2 years. Into 2, right? 2 million. I'm scaling up at 10%, I'm growing at 10% per month. So I'm growing at 200%, 175% per annum, So you put a premium to it. Whatever it is, that's a SaaS premium or whatever premium you call it. You put a 2, you put a 3, you put a 4. If the market is crazy, you put a 4 or a 5. It all depends on what is it the investor is seeking and how good you are. You get a valuation, right? So it's very simple, 10,000, so $100 into 10,000 into, let's say the lifetime value is 3, so that's 3 million. You put a premium into 2.5, 7.5 million. Oh, bang. Simple or straightforward. I'm not saying all of it is right. I'm just giving you ways in which startups are valued, right? Next is the stage of the startup. Which stage is it in? Startups are valued at different stages. We'll come to that in the last but one slide. Idea POC stage, you attach a value to it. Now, what is the number you should put over there? Now, I'll come to that, right? Next is the moment you tie up, you have a client, you tie up a client, you have a large client, your valuation goes up, natural. So that's another stage. Then you get traction. Or you do a strategic collaboration with a company or another tech major, or you tie up with a service, you tie up with a systems integrator. You go and tell TCS, hey, listen, this is what I have. I believe you're doing so much of work for Indian Railways. This is the product, and this is what my product can do. So what selling it, white label it, go ahead. You have a partner. So your valuation goes up, right? And then, I'm not saying that's the last stage. Now, there's a way in which a startup is valued. There are people who are betting on promoters, if they're serial entrepreneurs, or they're betting on people, or they're following the herd, or the fear of missing out. They want to have a part of it. Okay, so all this is primarily, there's no scientific way behind it. The last one especially, the first 3 years has some element of mathematics over here. The last one does not. It's just attributing something which probably should not be attributable, but you're putting a number to it, okay? So let's move now. So we haven't finished valuation as yet. We'll come back to it, but let's look at now that you are able to have a number in mind, or you have a way in which you think you should, ascribe a value to your company. What next? Now, what do the investors want? Now, here's where investors come in. Right. What is that? This is important. Now, this looks good, feels good on a pitch deck, spreadsheet. Does it work? Okay, the revenue multiple or SaaS approach or all of it. We'll talk about it. Right. I've broken this down into must-have good to have, nice to have. Must have. What is it I look for? Or what is it a lot of investors look at? Because I also co-invest along with a few people, friends of mine, or easy as I haven't, because it's because I'm getting too conflicted. So when Venki said, why don't you come and be a mentor? I said, yeah, it suits me fine. Because one is I don't have to invest. Second is, I don't want to take a remuneration because that way I'm free. Plus I don't get conflicted because the companies I'm interested in, they are investing as well. So I don't want as an individual to kind of invest. But even as an individual or as a professional representing others, what is it that an investor is looking for? One, has it been bootstrapped, or have you put in some monies? It could be from friends, families, whatever it is. It is a must-have. It's not a good to have, right? Next is a credible team and track record. Now, if you say, "Hey, listen, I'm new into investments. I'm new. I'm a founder. I'm not a serial entrepreneur. What is my track record?" It doesn't matter where have you worked. What is it you've done before? Even if you're fresh out of B school or whatever it is, what is it? I mean, what is it that you have that should make me trust you or believe in you? Next is product is in sync with a sector or field that is growing or slated to grow. This is what I spoke about, macro trends. Client validations, always good to have client validations. It's good that you go and do a POC, then approach an investor. Or let it be in POC stage when you approach an investor and say, hey, this is what it is. If you do not have a POC or a client validation as yet, have an industry expert, have someone senior, have a look at the product and say, hey, yes, looks good to me. Distinct product, founder, team characteristics, very important. Like, does a team gel? I mean, what is it that the product has? Is it one of those Me Too products? Why should I invest into it? Who's the founder? Now, I bet a lot on the founder. For me, the founder is extremely important. Domain experts, advisors, preferably an advisory board. Yes, it's good to have an advisory board. Equity imbalances. Now, what do you mean by equity imbalances? Now, I've seen in some cases, I was talking to someone about a year ago. This founder said, oh, we are two co-founders. So this chap had 50% of the company. The other guy had 10% of the company. I said, what is it? I mean, like, why this? I mean, did he come at a later stage? I want to know, give me a credible explanation. It could be, it doesn't matter. Your co-founder could have 2%, doesn't matter to me, but you need to have a credible explanation. You need to address it. Co-sale, tag-along, exit rights, which is very, very common, which is a must, which is like, I would, if you're selling as an investor, I would want the same rights. Or I may need preferential rights. Next is liquidation preferences leaning towards investor. I mean, I'm not trying to play cute, but I've decided now today, if I have to invest in any startup, I'm going to ask for a 2x liquidation preference. That may make me sound like a bastard, but so be it. Because what does it mean? It means that, let's say, if your startup is valued at 5 million, and there is somebody who wants to come and buy your startup out, or is trying to put in money or whatever it is, 2x is, I want to get paid 2x times before money flows to anybody else, right? That's your liquidation preference, right? So liquidation preferences leaning towards investors. Now, good to have all of the above, plus product is robust, product has traction. This is more at the next stage, which is your I won't call it a growth stage as yet. Yeah, it could be a growth stage, or it could be you're just kind of hitting the track, and you're saying that, yes, there is a visibility of client traction, or there are revenues which are visible. Paying clients or deals signed with large enterprises. Serial entrepreneur as a co-founder makes a lot of difference. Founders with a good professional background. right? Now, sadly, this is where your school matters, where you come from. It matters a lot. A clear chart explaining funding needs and the deployment of funds for the next 48 months is extremely important for me. And performance-based SOPs for founders and employees, right? Okay, and it has to be performance-driven. It's just SOPs, you know, you're just giving away the stock options. Nice to have is a real top honcho on the team or advisory board. Okay, this is a must. We'll talk about it. There is like, there's this particular startup I'm a part of. I sit on the advisory board. I'll tell you why I passed the investment and why, I mean, I shouldn't have, but I did. Again, one of the things we have is we have a top-notch advisory board. I mean, I'm the weakest link in the whole thing. I mean, you have some fantastic guys, and you know, and there's other startup where we are in the final stages of closing the round. I have two of the investors who have come in. I mean, they are kind of, they probably changed the course of India in 2000. So we're talking about, so these things matter a lot. These are nice to have. Credible co-investors, I always look at it. Who is investing along with me? Because if you want to raise money, unless you're desperate, don't look for dumb money, look for smart money. Whoever is putting in money, ensure that that individual or that institution give you something else. It could be in terms of leads, client leads. It could be in terms of time. It could be anything, right? The last one is, that's trying to be cute, you know, reverse vesting options for founders. Now, I'm not a big fan of it. I don't want to punish you as a founder. But what reverse vesting option means is, let us say at some point in time, a down round happens, or one of the founders need to leave, then I want to claw back. I want to make sure that, you know, the founder kind of, I mean, let's say that one of the founders holds 20%, 25%, 30%. I want it clawed back. I want it to go down, and I want those equities transferred to me. So that is a reverse vesting option. Okay. So I want you to be aware of this. Because see, it's like the Google or the I don't use an Apple. I still use a BlackBerry. Can you believe it? Can you see it? Yeah, there you go. Okay, so you just kind of, because I'm not a big fan of these toys, Apple or whatever it is. So what happens is, you know, if you look at an iPhone, they have these updates. So we all press agree. So likewise, as a startup founder, you could be desperate for money. So you just sign the document. I want you to be aware of what a reverse vesting option for founder is or a clawback is, okay? Okay, now comes the key thing, the dilution conundrum, okay, which is, first thing, do you really need the funds? Do you really need the funds? Ask this yourself. But having said that, go back to the second point I put, which is raise monies when the market wishes to give you monies, not necessarily when you need the funds. Markets could change. Look at what is happening today, right? I mean, like, you know, people are holding back. People are holding back, at least now they've got some confidence, whatever it is, they're looking at deals, whatever. Now, how much to dilute? Very simple. This is Paul Graham's equity equation. Have you heard of Paul Graham? Paul Graham was the founder of Y Combinator, or co-founder of Y Combinator. Okay, all right. Now he says the post money, if you're diluting X percentage, then the post money valuation of your company should be more than 1/1 minus X. Very simple. I mean, I wish, Shraddha, I tried using that whiteboard. I just could not. So I just wrote it down. If you guys have a piece of pencil or a paper, just write it down. Very simple. Let's say your company is valued at $5 million. You own 50% of it. That's $2.5 million. Now, you're trying to dilute 20%, right? So what happens? So the post-money valuation of your company should be 1 over 1 minus X, or 1 over 1 minus X, that 20%, right? It should be about $6.25 million, if I do the math. Or alternatively, what is your holding? When you dilute 20%, your holding will go down to 40%. 20% is 10%, take away that 10%, you hold 40%. So 40% of what value? 40% into, let's call it, let's not call it X. We spoke about X right now. Let's call it V. 40% times V equals 2.5 million. Do the math. When you do the math, you get the valuation for your company, right? Keep this in mind. Always keep this in mind. How do you raise capital? What are the ways to raise capital? Issuance of common stock, issuance of preferred stock. Common stock leads to dilution. Preferred stock, not necessarily now. At some point in time, it would lead to dilution. Optionally, convertible warrants. You could issue warrants, or what do you call it? Cumulative convertible preference shares. Or let's say your stock option plans. All this lead, right? When you want to, let's say you want to preserve cash and you want to give shares instead, dilution happens, your cap table changes. Okay. Now let's look at common stock and preferred stock, because I was having this conversation with someone this morning, and not this morning, was it yesterday? Last morning, yes. He said, "Sir, I have this investor trying to come in, but some of the investor has committed. So I don't want to take his money right now." Then I said, "No, don't push away Lakshmi." I said, when Lakshmi knocks on your door, I said, do not push her away. I said, do something, issue pref shares. Issue pref shares in such a way that this convert at the next round at a discount to an X percentage to the next round, 15%, 20%, right? And again, since I'm mentoring a few of the startups in the fintech space, and NSR had a gentleman call me up, and he had the same problem, and in terms of how much to do. So hopefully I sorted it out. I think I convinced him, because he wants to talk, he wants to kind of engage with me again. So I think, he must have found some value in that. All right. So you issue common shares, you issue preferred shares, you issue warrants and SOPs. All these things lead to dilution. Now, how much to dilute, that depends, right? It depends on where you are, what is your product market fit. You go back to the previous slide. Other clauses you need to look at is liquidation preferences. I spoke about liquidation preferences. I spoke about participation rights. Participation rights is all about, me as an investor, I would want certain voting rights and all that. Full ratchet is, let's say, if for some reason the down round happens, whenever the next round happens, I want to be compensated for that down round. And you have your investor rights. So I want you to keep all this in mind. Just do not raise money just for the sake of raising money. Keep all these things in mind, right? Now, this is a beautiful thing. Now, this sums it all. Can you see that? Now, if that bar is the value of a company, the founder's desperation pushes it down, and the investor's keenness pushes it up, right? Okay, so you arrive at some kind of a balance. So it's all about balance. Right? I mean, you could argue saying that, oh, I should have, because remember one thing, the most expensive equity you give away is at the early stage. So be careful about it. As you grow, as you become more predictable, your cost of equity goes down. The most expensive equity you give away is at the early stage. Okay. So let us revisit the back of the cover calculation again. Now data shows, okay, for an arm's length investor, let us say somebody with no strategic reason, somebody who's rational. I think all of us are rational when we make some bets on startups. There's a fair amount of risk we take. We are rational in the sense that we are sensible, we are sane, like how the Indian codes define being a rational human being, so that's what it is. So at an idea to POC stage, it's about anything from $200,000 to $500,000, is what it is. Let's say a crore and a half to about 3 crores is what the valuation is at based on deals done. And this is some information I've picked up both from the India scenario slightly, but a lot of it is from the US. Client order revenues about $500,000 to about $1 million. And, traction, strategic tie-ups is about upwards of, it's about $2 million. I think it's a fair thing for both you and the investor. Now, let's say a large deal, key breakthrough, you've established the scalability, you are a serial entrepreneur, then you can get about 3 to 5 million. You could come back and ask me, hey, listen, how come this guy, he doesn't know anything. How come just on paper with an idea, he's been able to raise so much and his company is valued at 20 million? I don't know the answer. It's illogical. It's illogical. And it's a kismet. To give you a short answer, to give you a not so rational answer, that's what it is. That's the sad truth. Now, another way to find out is what were the recent exits and who are the investors scrambling for a piece? Okay. Now, the last one, valuation is more a pricing game than a valuing exercise. I've come to that conclusion. Okay, it's a pricing game. Okay, you get into a pricing game with the investor, or you get into a pricing game with the people you're pitching. All right. Here is where a startup or a founder, of that matter, even an investor, needs handholding, because a lot of startups, they miss out over here. Because see, I can give some kind of an advice on product market fit. You may have domain experts, or you may have worked it out, but this is where a lot of startups miss out on this. And I'm glad that InvestorCell is doing these sessions, and people are reaching out. And I would advise you, I'm not saying that listen to me, listen to someone with experience in this sector. You can't go wrong. You just can't go wrong. All right. Now, let me just move. We're fine so far, Shraddha?
Yes.
Yeah, Shraddha, I'll take another 10 minutes.
Okay. But
and we'll open it up.
Yeah, questions are coming in. So yeah.
Absolutely. I'll wrap it up in the next 7 minutes. Okay.
Yeah,
right.
Great. Okay.
Right. Great. Where was I? Right. Right. So here we're talking about cases where I've had some personal experience over here, and just remind me to wrap this up with a story at the end of it. Now, first was a B2B startup. It was a voice tech startup. I was a brick and mortar guy. I had done investments on behalf of a private equity fund, but we were more into the infra space. We did selectively into discretionary space. This is one of my very first investments. Voice technology. I exited last year. I exited because of one was I asked them to do a few things, and the promoters, the founders did not. And but thankfully now they're doing it, and now it's doing exceptionally well. I exited. I made some decent money. I put in a small amount. I exited. I think it's not a bad return I got. Now, what was my learning over here? The focus was too much on making a perfect product. You don't have to, as long as you get the product market fit. Because the promoters held the IP very, very close to the heart. It's a great IP, but a lot of you may not like it because tech is increasingly getting commoditized, right? So you have to keep that in mind, right? The next is a fintech product leader. I met these guys. I had heard about them in 2010 or 11. I met up with them in 2013. I sat with them. I quite liked what they were doing. In 2014, this friend of mine, whom I said is doyen of private equity investing, he said, listen, I'm picking up a controlling stake in this. I'm buying out one of those guys. And, the guys who have backing the two founders, and he says, I'm going in, and he says, I'll give you the same shares at what I'm getting in. And I said, no, I just passed the investment, right? And today is the market leader. It holds about 70% of the market. It has the marquee of the marquee institutions as their client. It's a complete B2B. So I kept meeting them, and the founder was gracious enough to say, hey, sir, I need your help. Can you help me out? And I said, what way? So I sit on the advisory board of the startup. I'm a paid advisory board member over here. The third is a fintech growth stage, early stage. I was one of the, I won't say I was the very first set of investors. It was the founders and somebody who had backed the founders. I was the second set of investors. And this particular startup is now at NSR Cell, and it's doing well. Touch wood, I'm one of those early stage investors. I keep advising the founder. We haven't been in touch for a very long time, but we got in touch. We've been in touch in terms of, it keeps me appraised on what is happening, but I haven't had a call with him, which I did. I did yesterday, because he said, so you're speaking over here? I said, I am talking over here. And so we spoke about it, right? The next is, so again, what is my learning on number two is, why did they call me as a board advisor? Is they pretty much, the market is saturated in India and they want to scale overseas. So that's what I'm doing. As far as the fourth one goes, I was one of the first guys. This was set up by someone, and he wanted me to come in as a co-founder. I said, no, I can't. I said, I'll just be a director. I have too many commitments. So I sit on his board and I hold an inconsequential piece of equity. I keep advising them on strategy. It has done remarkably well. From zero revenues, I think this particular startup, I don't know whether I can call it a startup or not. This year, it should do about $15 million by December, right? We're talking about, in 4 years, and some real marquee clients, real marquee names. I mean, the Fortune 50 names over here we're talking about, right? Now, next is interesting, B2C and EdTech. I gave this guy some money. He vanished. He just vanished. These are lessons you learn. I mean, I quite liked the product. I quite liked what he was doing. I quite liked the individual, but I gave him a check, a very small check. He just absconded. I wish he had the courtesy to tell me. And because I had also introduced him to a people. It's unfortunate, but these things happen. The next is an EdTech startup, which I invested. I invested based on, I met the founder, and this founder and my wife were batchmates. They'd known each other for many years. The startup has since been acquired. I'm just waiting for the money to come out. It's a very small amount I put in. The next is a healthcare. It's India's, I think you'll find it in my LinkedIn profile. It is India's very first palliative continuum care thing. We've turned profitable. The focus was on cash flows right from the beginning. I kept telling them, and the founder is a chartered accountant, so which helped me in a lot of ways. The way is, beg your pardon. And I kept saying that manage the cash. She did that beautifully. And today we're profitable, and we're getting some marquee investors into the company, right? The next is a B2C, which is, I quite like the idea. I quite like what he was doing, because there's a friend of mine who's an investor in this, called me up. He says, can you look at them? And it is more in the social media space. I quite liked it. I gave him a few pointers. The reason I passed it was, I said, listen, I just don't have the time, but I quite like the idea. So you pass a few, the gist of it is you pass a few investments, because not because they're not great. It's just because either you don't have the money, which I do not, and second is you don't have the time, or you get too drawn. So consciously, I've realized that I don't get too interested or too excited about an idea these days. I've consciously decided, because I'll be doing a disservice to my existing investee companies and my other firms where I sit on the board. I owe them my time, a responsibility, right? Now, what are my learnings? I'll just kind of, but before I get to my learnings, I'll just talk about, I'll just tell you one story. This is about 3 years ago, almost 4 years ago, since we're talking about valuation, there was this particular, I won't call it a startup. It was in the medical business. It was in the testing business. It was one of those labs, and it was privately held. There were two marquee large private equity investors who were invested into it. And so I spoke with the promoter's daughter, who was now the promoter. I mean, she pretty much runs the business. Of course, she has a professional team. I said, "You planning to go public?" She said, "Yes." I said, "All right." And she asked me, "Do you have any advice?" I said, "Who am I to advise you? You built a fantastic business." But having said that, I told her, "Hey, listen, I mean, try to take in inputs from the private equity guys. I mean, don't ignore them, but try to take some inputs, because then I said, end of the day, I said, make sure that they win, because you never know. You always may need them." And she said, "Yes, noted." Interesting. I said, "What do you plan to go public at?" So she said, "At 50x of my earnings." I just fell off the chair. I said, "Don't do it." She said, "What do you mean don't do it?" I said, "Listen, money is not going to come into the public. It's an offer for sale. It's not an IPO where money goes into the company, where money is churned." She said, "It doesn't matter. Money is money." She said, "End of the day, everybody's at a good run." And I said, "I want to kind of, as you said, yeah, the PEs are going to benefit." She said, "I want to benefit. It's an offer for sale. It's not that I'm offloading all my stake, right?" She said, "Okay, you tell me, what do you think I should go at?" So I told her, I said, "Listen, the PEs are about, between 25 to 30 right now for this kind of business." She said, "Okay." And I said, like, maybe some companies, it's at about 40. And I said, "Since it's an offer for sale, I want you to go at 20. Her answer was, she said, "Krishnan, I thought you were intelligent." She said, "You're just like anyone else." Then I told her, I won't mention her name. Then I told her, "Hey, listen, thanks for the compliment, but it's an offer for sale." And she said, "No, I'm going to go." She said, so then she sat with the investment banks. The investment banks didn't allow her to go at 50. She went public at 40. Okay? Today, that stock is trading at a multiple of 70x. So I was wrong, because I went by the numbers. I went by data. I went by earnings multiple. I went by DCF. I did everything possible. She knew the market, and she had a better pulse of the market, right? So the lesson I want you to take before I give you my lessons is, if you are so convinced this is what you wish to dilute at, so be it. I had a second call with a gent from LSR Cell, one of the incubating companies, and he told me, he said, "Sir, this is the value." I said, "Listen, I think it's a bit high. I think you should work on this valuation." He agreed. He said, "Yes, sir, I think so too." I said, at the same time, I said, "Listen, you pitch at what you think you believe in." I said, "Do it," right? So that's a lesson I learned. Now, what are the other lessons I've learned? One is, I've always believed in entrepreneurs who wish to create value first. Valuation would naturally follow. This lady did a beautiful job. Rather, her dad did it. And she took over, she kind of moved up the value chain. Now, in a majority of startup investing, it's driven by non-quantifiable parameters, okay? Valuation is driven by non-quantifiable parameters. So when you dilute, remember you're in the pricing, not the valuation game, all right? Look at that slide. I spoke about that particular slide, which talks about investors' keenness to get in and the promoters' desperation to get the money, right? Honest with your investors and prioritize housekeeping. This will go a long way, right? Lastly, don't ignore signals from the market. They may not be correct, however they convey something, right? So that's it. Are we good, Shraddha?
So, Krishnan, Vikat, yeah, that's good. I think we have a couple of questions.
Sure.
So maybe we could.
Before that, Shraddha, my apologies. I said 1 hour. I kind of hogged a lot more than that. I'm so sorry. I hope people are on board and haven't run away.
No problem, Krishnan, but I think we can start taking questions.
Go.
Yeah.
You want them to come and ask the question, or how does it work?
There are a few questions on the chat box. I think it is open. You can also see, and I think few of them would have dropped you in person also.
My God.
Yeah, maybe we can take in person.
Can you go to the second last slide? Mansi Mudgil to everybody. Right. Go to the second last. Is this the one?
Yes. So what we'll do is maybe go a little above. So now I think Bharat has asked a question.
Shloka. Okay, right. Let me just leave this.
Or maybe